right, everybody. The clock is ticking. Find your seats, please. Hello. For anybody who was here in the last session, I'm Shannon Richards. You've already met me. I own a company called Hay Runner. I'm a licensed broker with Sotheby's. My company has real estate, design, and construction services. I'm the vice president of MEREDA. I help produce all the content here at MEREDA. We have a podcast, and I would ask anybody who's interested in becoming more active from our current membership. New members, please join, but anybody in our current membership who wants to become more involved, we're always looking for people to join us in committees. And Kim here is actually on our board. David, you should be. I'm ruthless at recruiting. Join a committee, come on. So with that, everything's kind of dull roar, shut the door. Come on in, guys. So with that, we're going to talk about financial trends. So this year, we had heard some negative feedback about the prior forecast conferences. Our forecast conference is our biggest event of the year, and we always think it's the best one. I mean, nearly 1,000 people right before the pandemic came. So we were looking to reinvent it a little bit because we felt like it was maybe getting a little stale. So this is new, and we were not sure how many people would show up because of COVID and whatnot. But if it's less formal, feel free to reach to yell out a question if you have one. We really wanted to create more of an interactive environment here. The more people that are in the room, I know it's intimidating to yell out, but please feel free. And with that, I think I'm just going to introduce Kim Twitchell, and she's going to start us off.
Hello? Can you hear me all? Okay. Well, thank you, and I'm going to attempt to control the clicker. If you are not here, or if you are here thinking that you're hearing about construction, you're in the wrong room. We're talking about financing trends today. And
did I say that?
No, oh. I'm kidding. And so we just wanted to talk a little bit about what some of the bankers are seeing for financing and more about what's happening in the economy as well. So for those of you that don't know me, I'm Kim Twitchell. I work for NBT Bank here in Portland, Maine. I run their affordable housing new vertical, which they just implemented in September. We started in 2014 here in Portland, but we are a small regional bank. We're about, I'd say, $13 billion in assets. We cover upstate New York, Pennsylvania, northern New England, with one of their corporate offices here in Portland. Our office is on Widgery Wharf here. So what I thought I would talk about is some of the types of financing that we have done in the state of Maine. 200 Federal Street is the tallest building in Maine project. We were the lead bank on that project. That's just about finished right now. That's a multifamily. That was actually started before the Green New Deal and the zoning ordinances around affordable housing here in Portland. We also have financed 115 Congress Street in Belfast, which is an affordable housing project. That is a project that took advantage of the low-income housing tax credit program. And that's under construction right now. And also the VA clinic in off of West Commercial Street here in Portland. That was office medical use. That gives you an example of some of the projects that we've done recently. They tend to be larger projects. We have expertise in commercial real estate financing, construction financing, and our team has done a lot of the larger projects here.
And you've been doing this for a number of years.
I've been doing this for about 35 years. Thank you, Shannon, for bringing that up.
I just wanted to mention she's an expert. That's all.
Thank you, Shannon. Yes, I've been doing it in the Portland, Southern Maine market for a long time. I do sit on the MEREDA board. I've sat on the MEREDA board for a long time, too, since 2010. So if I don't know you, I should know you. Okay, moving on. So talking about some of the trends and some of the key economic factors that really go into what's happening, a lot of what we gear our financing to, it's interest rates, right? And so to get to the interest rates, what's happening in the economy and what's the FOMC, which is the Federal Open Markets Committee, looking at in terms of indexes. And one of the indexes is growth, the GDP, and what's happening. 2023 was a very challenging year for banks. When you think about what happened with interest rates and the rapid rise in interest rates, there was some growth, but we were really concerned about a recession. And I think now when we're thinking about what's happening in the global economy, the U.S. has performed quite well. And so we are thinking in 2024 that GDP is going to settle in around 2%. And I think with that, we are feeling that there's going to be no recession. We feel that, where with the growth factors are, that there really won't be a recession.
You heard it here first.
And we are seeing 2024 as a more optimistic year. There was a 60% probability in 2023 that we were going to have a recession. We're seeing that come down to zero in our mind. Obviously, things can change. And a big piece on that is inflation. Inflation has come down incredibly. I'm just going to skip over a few slides here to show you what the core PCE is, and this is as of the end of December.
PCE?
So it's the consumer, how people are purchasing consumer goods, and so when you think about, and that's one of the key factors in that the Fed is looking at for inflation. And when you think about where it was over 9% in 2022, and now it has just come down in January as well, but in December it was 2.9%. So we really feel that inflation, albeit it's going to be slow getting down to 2%, that the target that the Fed is setting at the 2% level is going to be something that everyone is gearing towards, and something that we will certainly perhaps get to, but it's going to take a little bit longer. And it's going to be the next piece, the decline is going to take a little bit longer to get down to the 2%. But that's really where we're getting to.
If any of you are JV players out there like I am when it comes to finance, it's just why it's perfect that I'm asking questions for everybody. I listened to a really great podcast on Planet Money that explained the 2% of inflation. So if anybody doesn't understand it, because I know you guys understand it like that, so I just wanted to mention that to everybody out there who's not a professional finance person.
There you go. Thank you, Shannon. And I think the other factor that is another driver of what's driving interest rates is unemployment. We heard earlier today about the unemployment rate. And while unemployment rate is around 3.7%, 3.8%, we think that is going to tick up a little bit, but it's still phenomenally low. And when you think about in the state of Maine, small businesses are still really struggling to find qualified help and help at all. So that we think that is another factor that's going into the decision around interest rates. So I'm going to back it up, and we are all keyed in on when are rates going down, when are rates going down. Well, I think we all feel that there's a very, very, very small probability that they will actually decline in March of 2024. What you see across all of these color schemes is the Fed's fund probability of the rates and where they're going. Right now, they are at that 550 level. And when you think about all of the dates that are around the lower bar, you will see that's when the FOMC meets and decides whether or not interest rates will actually fall. In May of 2024, there is an expectation that perhaps we will see a small rate decline. I think given the economic news that it's recently coming out, I don't think that probability has increased. I think it actually has decreased. And I think realistically in May, we probably won't see a rate change, but again, it really will depend on the economic data, and perhaps we may see something in June of 2024. I think when we were looking back in November and December of 2023, there was speculation that rates would fall 5 to 6 times throughout the 2024 year. We're not seeing that anymore. We're seeing 2, maybe 3, but I think as the Fed continues to evaluate the data, they're really in no rush to change interest rates. And they're really going to make sure that they're deliberate in how quickly, if at all, they change those rates. Now, there is a lot of speculation that rates are going to decline before year end. Your guess is as good as mine. We don't have the crystal ball, really. So we're all kind of gearing into what's happening in the economy. We are in an election year, and that is a big thing. And as we get closer to November, the likelihood that the Fed is going to reduce rates and reduce rates dramatically gets less and less. That's what we're thinking. And so I think at the end of the day, I think we all need to think about where we are with some of our projects, where we are with penciling out deals. And from a bank standpoint, rates are higher than they have been. We were, I think, very used to 0% interest rates. Well, that's not realistic. I think today they are more normal than they have been. And so folks need to get used to that, and you need to make sure that when you're penciling out your deals that you are taking into consideration where rates are today and not think about where they may be in the future, especially if you're anticipating a rate decline. I also think that banks, when we think about some of the commercial lending banks, and that's my experience on commercial lending, we are always looking at credit, and when you look at new projects and you think about some of the pro forma that's happening, they're speculating perhaps rent increases. We're not seeing the rents increase the way they were, especially in the multifamily segments. And so, I think banks are starting to take a second look at some of the pro forma that's out there, really trying to understand what is happening from an absorption rate standpoint, and maybe perhaps putting in some other guardrails around some of the pro forma that they're seeing. So I also put down cap rates. Cap rates have definitely increased. So as cap rates go up, the values go down. But sellers, I don't think, are adjusting to that and perhaps holding on to some of the old selling prices that they had anticipated receiving and saying, oh, well, when rates fall, we'll get those. We can be patient. Well, I just want to kind of caution everyone, if rates fall, they're not going to ever go back to where they were. So think about that.
Great. That's awesome. Is this the last slide?
It is the last slide.
Okay, great. With that, we'll hand over the clicker to Matt Early of Gorham Savings, also a board member.
Yes, thank you, Shannon.
Thank you so much.
Nice job, Kim.
Yeah, very good.
It's great to see a good crowd here once again, and thank you, Shannon. Thank you, Kim. Thank you, MEREDA. I've been a board member at MEREDA for a number of years now. I serve in the membership and marketing committees as well. I'm Matt Early. I'm a commercial banker at Gorham Savings. It's okay to stand? Yeah, please. Okay. Okay, I apologize for putting you on my back. Commercial banker at Gorham Savings Bank for over 20 years now. I've been in banking for about 30 years. Began my career in '92, coming out of the University of Maine. I started at a bank called People's Heritage Bank at the time. That proceeded to be Bank North and is TD Bank today. It was an interesting time in '92. I was a young guy out of college, kind of knew computer skills and technology back then, and so they put me on spreadsheets, and these spreadsheets that I ran were full of hundreds and hundreds, if not thousands and thousands of bank-owned properties. It was a department called the Oreo department, other real estate especially owned. And it was a unique time. I'm not trying to predict the forecast that we're headed towards that again at some point in the future. I've not seen anything like that since, but uniquely, I kind of backdoored my way into banking. The banks at that time, after the savings and loan crisis before, just had a tremendous inventory of real estate. But it was kind of short-lived, It wasn't long. It was a year or two later, I found myself in the credit department at the bank, and we were roaring ahead. A leader by the name of Bill Ryan of the bank at the time began acquiring other banks. There was a lot of growth, all the workout loan officers at the bank. It seemed like every loan officer was a workout officer at the time. Soon became origination officers again, and I'll get to some slides later, I think, that kind of show some of that period. I work at Gorham Savings, as I said. We're about a $1.7 billion community bank, headquartered in Portland, Maine. We're a mutual savings bank. There's no stockholder. The mission statement's not about improving the financial wealth of a stockholder. It's more about the stakeholders, and the stakeholders, the community, the employee, and the customer. And you may have caught in the news that there's a big merger. It's pretty big news. We're going to be merging with Maine Community Bank. They're a little bit smaller than us, but combined, we expect to be close to a $3 billion bank. The scale and capacity of that's going to be important for the two banks, the one combined bank, to sustain itself for another 150 or more years into the future. Everything we see today is just costing more money, technology, regulation, the scale of the projects. I'll share some projects with you in a little bit, and some of the other stories about how there's been a lot of collaboration between community banks to sort of make things happen in terms of scale and capacity. There we go. Kim, we're going to kind of, I think, share a bit on, I think David too. I mean, we kind of, got some of the same stuff. I don't know that we necessarily covered the yield curve on Kim's slides, but one of the unique things that this presents, and it's a challenge for the banks today, in how we price our assets. And part of that reason is the short end of the curve. This is an inverted yield curve. And the short end is where our liabilities lie for the most part, the deposits that we have at the bank, the borrowings we do. The banks will pledge their loan portfolios to the Federal Home Loan Bank and the Federal Reserve. And so we not only have the deposits at the bank to use as a resource to make the loans and investments we do, but we have a capacity to borrow from those two other institutions. And we're paying at that short end for those instruments at 5.5%, 5%. And then you got a curve that's down right now at like the 5-year at a low of 4%. So historically, banks might try to, on average, get a 3% margin on a loan that we do. So you might say 4 plus 3 is 7, but 7's kind of tough today because we're paying 5.5. So the 7's only really a 1.5% spread for us today. So it presents a big challenge for us. Hopefully, Kim was talking about the dot plot and where the forecast for the cost of funds will go. There was an expectation that the short end would come down a little sooner. There's some question about that now. As bankers, we'd love to see that happen. We'd love to see a traditional curve. I think that could benefit everybody. Margins for the bank would improve, and what we could offer you for pricing on the loan side would be, I think, more attractive for all. A little something on the prime rate
Matt,
history.
what would make that happen? Do you know?
I'm not an economist. I'm a banker. It's been 30 years here locally, so I've seen a lot here locally. It's just sort of the leading indicators: consumer price spending, inflation, employment, all of that. The data and the statistics are what are going to drive their decision making. I think we've been hearing from the Fed that they're just waiting on that data. That data is critical. And I'll share a little more on that in a little bit. Just thought it might be interesting. This goes back to what, 60? There's a thing in here, right? If I can make it happen. No. Is the pointer working? No?
Oh, at the bottom. Yeah, there you go.
Forget it. I'll just try to describe it. 92's when I got into things. It was kind of going up, came down, it kind of went up, and it was pretty good for a while. There was the dot-com kind of excitement and everything, and then Y2K, and then a crash from that. And then we got cooking again, and then we had the no-income verification loans and the derivatives and all this creative stuff that was happening. That was really great and drove a lot of growth and opportunity, but then that came to a head, and there were bank failures and insurance company failures and a collapse. And then look at this. You never saw this 2010 on. I mean, we started it before COVID kind of come up a little bit, but then we came up, but that's really unprecedented, right? This 0% free money, and for how long that happened just really stands out to me. And, as you know, inflation just roared, right? The price of everything, took off. There was a lot of excitement, a lot of opportunity for everybody. It's really hard to go wrong, with anything you did. And then, now the Fed kind of catches up. Oh, there was also all this stimulus spending, right? Like money, trillions and trillions of additional, federal debt. And we saw it. I mean, Gorham Savings alone, I think we put out about $200 million here locally in PPP monies just in 2000 and 2001. And a lot of the community banks and all the banks, we all were just, full-time working, from home, processing these things. But, $200 million is pretty meaningful for us, and I think a lot of our customers. And that all landed in the bank, too. Those deposits kind of came in, and the banks became pretty flush with liquidity and deposits, as did many of you and businesses and the investments that followed. So then they start to try to catch up on rates and bring them up really fast. This is kind of a depiction of the same thing. The Fed funds rate is what commercial banks kind of deposit and borrow through the Federal Reserve with one another. You hear that referenced more often. That's kind of what they're talking about with rates, but it really mirrors the activity of the prime rate. The prime rate, what the bank would probably loan you money at, that's 8.5 today. The Fed funds rate is 5.5, 5.25 today. Here's just kind of another graphical depiction of the dot plot matrix, what the Federal Open Markets Committee was predicting. And they do this quarterly. This was December's. And, they were all this is every one of them. There's like 19 or 20 leaders there, Powell being one of them, presidents of the different Federal Reserve boards. And it's kind of where they all thought things would be. Some thought maybe things wouldn't change too much in 24. But the bullseye of it was kind of about a 75 basis point, 1 point reduction or so, and then going out to 25, 26, getting us down to that, 3% kind of range.
I have no idea what's going on.
Yeah, all right. So, okay, the pointer don't, oh, here it is, there it is. That's not working. Oh, I got a pointer up there. All right. All right, so there's like 19 or 20 of them. All right, one thinks rates are going to go up this year. One thinks they're going to stay the same. Well, the two kind of think it's going to go up. And then some of them think it's the same. This is in December. Some think it'll go down a little bit. And this is for the year, though, however, 24. Most of them seem to be kind of in here, right? So it seems like the majority of the people that are going to make these decisions on where this rate's going to go are thinking it's going to be there. And then again, so they all have their opinions. That's an opinion of every one of them. And you can kind of just try to look at the consensus opinion somewhat to do your predictions. Is that a little better? Yes. Okay. Let me go back to that, actually.
Oh, no more. Go on. Get up.
Just highlighting the increase again here out on the right side, and how rapid it was here this past year. And one thing to just highlight, that happened and still is ongoing in our industry is tightening regulation and concern about the overall health and state of the banking industry. We had some bank failures, Silicon Valley Bank, First Republic Bank. What was the other bank? There was a few. Signature, a few, very significant large banks that failed. And really it was largely a result of that, along with some management practices and just overall kind of modeling and schemes. But it really shook up, the federal government and the banking industry for a bit. By now you probably heard of some of the unique characteristics of those banks. They grew so rapidly with their deposits. The deposits were largely like crypto and venture capital. It was really super hot money, and it came in really fast. When that happens, what do you do with it as a bank? You don't have time to make a bunch of commercial loans or mortgage loans and diversify your assets. You go buy mortgage-backed securities at like 2% back then. So they're paying nothing for the money. They had a lot of it. They put it in the mortgage-backed securities at like 2%. And then everybody came for that hot money real fast. And they got to figure out how to settle it up. So they got to sell those mortgage-backed securities, but now mortgages are 8%. So they're worth 20%. They got to sell this stuff off, and they sold it at losses. They didn't have the capital, liquidity capacity to absorb the demand for the deposits.
So don't be risky.
Yeah, you know, you
banking.
just being, I mean, the banks around here are just so different. Those deposits were so concentrated and huge, like 90% of their deposits were uninsured. I think at our bank, we're trying to figure it out. About 80% are insured. You know, we don't have huge concentrations of big depositors at risk. It's diversification, like really any business just about, right? Try to be diversified. And there were some management principles and practices too that were questioned, but we're all feeling the heat still. You know, the regulatory
hot money.
Constraints and stuff.
I'm quoting you.
Yeah, hot money. So I don't want to pass up that. I think that, you know, the state of the banking community is strong, vibrant, and healthy. There was really some unique characteristics there. I'm going to now share just a few of the projects that we've done, and I think some of the unique characteristics of these projects. Brian O'Coin worked with Sean Ireland up in Bath, redevelopment,
He's
repurposing.
in Mexico today, I know that.
Sean is? Yeah. Repurposing of a long-time vacant downtown space in Bath. You know, I'm not in the community myself, but I've heard a lot of positive things about this. You know, today is some co-working space, theater, apartments. But one of the, I think, important things to highlight with, and most all of the projects I'll highlight, is just, you know, the characteristics of utilization of some non-traditional tools and instruments in the projects. This one had historic tax credits, both state and federal, in it. So that was a tool and instrument that was, you know, pretty important to helping that get along. MEREDA's been active in advocating for the continuance of those programs with the state.
Yeah, the historic tax credits come up for a vote on a regular cycle. I forget how often, but we always have to kind of make sure that it gets passed
Advocate
again.
and it's been important to a lot of projects, not just that one, and a lot of Avesta Housing, $22 million, 48 affordable and 12 market rate project. Just started taking occupancy not long ago. Just again, highlighting this using some LIHTCs. It was a 4% deal, so Maine Housing did the construction financing on this. I got involved with some grants from the Federal Home Loan Bank, some direct monies into it, plus they have a program where it can subsidize the interest rate we provide to this deal. So I was able to reduce the interest rate I provided to this, probably 3-4% below what market rates would otherwise been, utilizing that program. The city, Cumberland County, Efficiency Maine, typical of a LIHTC deal. There's the capital stack of a lot of participants, below market funding sources, et cetera. I think this is 60%, 50% AMI on those 48 affordable units. That means those people are paying like $800, $1,200 a month for those units, you know, well below market. So ultimately, the value of this when it's appraised because of the restricted use agreements in place on that deed-based for that, you know, they're worth less because the income that comes from it is less. And so it needs these tools to make it happen and to deliver an important source of housing to people in our communities. Homeless Service Center, most folks familiar with this probably in the area. This is a $25 million project, Developers Collaborative. Chimbro was the contractor on it. This was unique in that it was like master lease agreement with the city. City also had some money, several $1 million of federal monies that it put into this, was able to buy down the debt that we had to put onto this. It also bought down the lease payment they had to put into it. It's a 10-year lease with a $1 buyout at the end. I hope I didn't share too much there. Yeah.
We just gave an award for it. It's okay.
This is one of the first projects here in recent years that was completed on time and on budget. I think a lot of us experienced delays because of COVID.
That's why we gave him an award
and stuff. And also, I wanted to point out that Kennebec Savings Bank participated with us on this. I think I alluded to that earlier. There's been a lot of collaboration between community banks of late. The scale of things. Gorham Savings, for example, our in-house policy limit is $20 million to any one borrower. It's about 30 legally. So a lot of the community banks have similar sort of restrictions, and we'll participate with one another in order to try to do these projects that have really scaled up in size of late. Am I running out of time? Yeah. Okay, sorry. Washington Gardens, sorry, I'll pass through that from Portland Housing. That was a reuse. There's a public housing conversion going on there. Same stack. This was a neat project in Scarborough. This was Jack Soley and Tim Hebert. They bought the former public services building, the police and fire station. This was a site that Avesta bought off on the side of it. There was a TIF from the community of Scarborough in this one. This is senior housing. TIFs are important. They're supportive. Helps us kind of put together a pretty costly project along with other similar sources again to finance this at a right size so that we can keep those rents low and affordable for folks. Portland Commerce Center, this is a little more conventional in Portland. This was purchased by the Ram companies from Peter Holmes, more just an investor acquisition. They believe there's some below market rents in there. You know, as a banker, you got to try to figure out whether you believe that or not. One of the things that was, you know, unique about this, though, deals are tight. They're hard to pencil at rates and everything today, as we've been saying and seeing. But there's a lot of equity in this deal. These guys brought 50% equity to this deal, so it makes it a little easier. That's what I'm seeing is people 1031 exchanging, so you can still make something happen, but it takes more equity. You know, you can't do an old 80% debt, 20% equity, 20-year amortization, and expect to get your 1-2 debt service coverage that the banker wants to see. It just doesn't happen with selling prices
So you're
still
saying
high.
Cash is still king?
Cash is important, yeah, to make a
Getting all
deal
the
right
sound bites.
size. You know, maybe like things are going to normalize. Rates, I don't think are going to change a whole lot. Where do we go from here? Yeah, questions about whether rates decline or not. I'd love to see them come down on the short end. I think that would help a lot of people out, you and I both. I think it begins to flatten a bit, maybe not as soon as we had hoped. I think we're going to just still see slow growth and activity. Deals are hard to pencil. We got to be a little more creative about them. We got to maintain credit quality. That's important. Regulators expect to see that. Like I said, we borrow from sources. They collateralize it with our loans. If our loan credit deteriorates, they won't lend to us. Liquidity, that's the biggest concern in the industry. We can't let that happen. We got to maintain liquidity. I've just seen a lot of flat revenues and maybe flat to declining margins across the board. I think we're going to kind of continue to see that as well. So sorry if I went over. David.
No, that's fine, Matt. You're very entertaining.
Yeah.
Don't I love it when we can get somebody who's excited to talk about numbers? I mean, we all are, really. And with that, David Hulit, who is going to tell us about how you can think about when there's not an upside, SBA.
Hi, everybody. My name is David Hulit. I'm with Ready Capital. I'm Vice President of Business. I'm a Business Development Officer. We are a national REIT. I work in the SBA division. We're the 4th largest commercial mortgage REIT in the country. The only ones bigger than us, think like Blackstone. We are publicly traded, so we have investors that really care about how much money we make. I'll throw that out there. And we are the 4th largest SBA 7A lender in the country, but not in Maine. We do what SBA 7A, if you don't know what that means, I'm sure you don't. That is a government-guaranteed loan program. Think FHA for businesses. It is a credit enhancement that incentivizes lenders, traditionally banks, but also 14 non-bank lenders like ourselves to take on maybe, for lack of a better word, riskier loans that the banks wouldn't do otherwise. You could say for reasons such as maybe higher leverage, higher LTVs, lower credit scores, historical bankruptcies, foreclosures, et cetera, or typically large undersecured exposure. For a room of commercial real estate professionals, maybe that's not your average thinking is collateral shortfalls, but what we are seeing now is lots of trades businesses. We call it the silver tsunami. A lot of the boomer generation selling their businesses. So think plumbers selling their businesses, electricians, et cetera. A lot of goodwill in there. Say there's no commercial real estate, SBA 7A is the program that finances that. So when you're ready to sell your legacy business to your manager and they've got little to no money to put down, we're the lender that does that financing. And we'll do those loans up to $5 million. So I'm born and raised in Maine, went to Portland High School, graduated from USM, currently work remotely. Worked remotely before the pandemic. Y'all just joined me at home. I was kind of used to it. It's kind of nice. So when I call people, they're kind of used to it now. But we do loans all over the country. I personally was the 3rd largest lender in Alaska. I've never been to Alaska. That was only 2 loans, so it's not that impressive. One was big. So we're doing it all 4 corners of the country, and even Hawaii. I haven't done a loan in Hawaii yet, but if any of you got a business in Hawaii, would love to finance it because that'd be pretty cool. I represented actually closer to 20% of Ready Capital's volume in 2023. So that's I think why I'm up here. We were established in 2011, and we are the largest non-bank SBA 7A lender in the country. And we have another division that does, large bridge loans, CMBS, Fannie Mae, Freddie Mac. I personally don't know anything about that, and those guys don't know anything about what I do. It's very niche what we do. But we do some business in Maine. So occasionally when the great lenders in our state, and we have incredible lenders, I got to tell you, business owners, Maine is very well banked, and that is incredibly good for you as a consumer. I do a lot of business in Florida, Texas, California, et cetera, because it's just there's not as much competition. MBT, Maine Community Bank, Gorham Savings Bank, they're all going to give you the best rates, and they're going to compete and do a great job for you. But when there's a deal that just doesn't fit their credit box, I'm who they call. We don't take deposits. We are just a transactional lender to get the deal done. So we did the Barncastle Inn up in Blue Hill, Maine. This was a change of ownership. It was a young couple from out of state moving up here. They were repositioning this historic inn. It's a very heavy restaurant. It's only about 5 beds, about 75-seat restaurant. This was a projections-based change of ownership, business acquisition with about 10% down. That's the type of deal that we're able to get done. And from a bank perspective, what we see typically is business owner gets in, stabilizes the property and the business for 1, 2, 3 years, and then they refinance us out into their local community bank, their local lender at a lower, more attractive rate than maybe what we're offering. Booker's Restaurant, this was a great deal that we did in Philadelphia. If you've been to Philadelphia, I would suggest you go here. This was a change of ownership as well for a restaurant. These were 2 business owners who had no restaurant experience, buying, it was about a $2.5 million deal. Good thing is when you buy a business with real estate, if greater than 51% of those proceeds are going to real estate, we can put that on a 25-year term. The SBA program has very advantageous term lengths and down payment requirements. This was a story that I really appreciated, and this kind of lead into kind of where I think the trends are in my industry are going. But the SBA, Small Business Administration, that's what that stands for. They're really expanding access to capital. That's the whole idea of the program. Is if you have the experience, you have the vision, maybe you have the collateral. They want to find a way for you to get the loan. And this was a gentleman and his wife who purchased this business. He had a historical felony, and from the 80s, but banks didn't want to give him a loan because of that. Fully collateralized deal, but there's a stigma with that. He actually received a pardon from Chris Christie, and he was represented by President.
Oh my God, I need to know more.
Represented by President Obama as the 12 Champions of Change, and other banks still would not give this gentleman a loan. He owned other businesses, was actually a real estate developer himself, and we were able to get that deal done. They actually colloquially nicknamed me the felony lender because I've done loans for 5 felons, but they do very good jobs. And that business is up year over year, 25% revenue growth. They're absolutely crushing it. The SBA enables lenders like ourselves to believe in people and to give them that chance and let them succeed. Eagles Nest gas station, threw this one on here. This was during the pandemic, ground up construction of an independent gas station in Newington, Connecticut. That was done with 15% down. We do ground up construction. So from the developers out there, we're going to be doing ground up construction in gas station, self-storage unit facilities. It's really kind of a popular thing that we're doing. I'm doing one down in North Carolina. It's actually a repositioning of a retail. We're seeing a lot of, vacant Kohl's, something to that effect. We've got a self-storage unit developer. We're going to finance that repositioning, $2 million loan, no money down. So that is going to be something where, cash is king for traditional banking, but leverage is where it's at. That's where, but there's a catch. Our interest rates are tied to that prime rate. And remember, prime is at 8.5. And so it has been an interesting period of time for the Fed funds rate and the prime rate. And this right here is showing the Fed funds rate as it compares to the SBA expected loss. It's all about risk. When we're doing high leverage, low money down, lower credit scores, loans for felons, you got to think, well, there's probably some risk baked in there. And so it's not as much as you would think. That's what's kind of interesting. So you can see here as the kind of like to go back in 2004, prime rate, Fed funds rate started to rocket up. There's about a 2-year lag before you saw the chaos impact the SBA loan pool and peak defaults in 2011. And right now, this is about a year off, but we're not seeing that yet. The majority of SBA 7A loans are done on variable rates. I know most people in Maine want to shoot me when I tell them that. So, but these are floating rates adjusting quarterly. That is the industry standard for SBA 7A across the country. So we're talking prime plus 275. Nowadays, prime plus 3, 11.25%, 11.5%. When these business owners were getting these loans, they were getting them at 6%. Now, that's a pretty drastic increase. But when you look at it on $1 million loan, we're talking monthly pays going up by about $2,800 from bottom to top. It's a lot, but it has been manageable. What we have seen is the historic default rates are trending towards the 30-year average. So right now, it is not worse. It may feel like it's worse because the historic 10-year average was incredibly low. And why was it incredibly low? It's like Matt said, there was that period where the prime rate was at the floor, and there was all of that free money. We're talking EIDL, PPP, ERTC. An incredible amount of free money was pumped out of the government that kept defaults historically low. And having interest rates at the bottom and suppressed for a decade after the financial crisis also kept the default rates low. So we're just trending back up to the 30-year average. It feels worse because the past 10 years are bad, but it's actually not that bad. From our perspective, what that means is as a non-bank lender, as having investors that want us to make money, we are not slowing down. We are aggressively lending. In cases, we're lending more than we ever have before. Last year, we did about $550 million in SBA 7A loans. Our target over the next 2 years is to hit $1 billion average. To do that, we have to lean in and take more risk. And where we are seeing banks maybe pull back a little bit because of liquidity, regulators, FDIC, et cetera, we are only regulated by the SBA, and the SBA's mandate is for us to get capital out the door to small business owners. I like this chart here because it's kind of interesting. You can see the national average in blue, and I wish they picked a different color, but below that is gray. That's the Maine default rates. Maine has historically always been a lower default rate than the rest of the nation. Maine bankers are very good at assessing risk, but one might say too good at assessing risk. The idea of the SBA loan program is to incentivize taking on risk. It guarantees 75% of the loan so that you can lean into those riskier deals. And when a bank doesn't want to do that, that's where the non-banks fill the void. But it is a kudos to Maine because we just smoke the rest of the country in default ratios. We really have strong businesses, and our portfolio has been that way for the past, ever since inception. And this is a little bit of a larger look at this. This data, by the way, is from Lumos. They're a small business data analytics company. The former CFO of Live Oak is the CEO of this. I'm not getting paid to say that, but they gave me this for free, so I'd like to put it out there. Live Oak is the largest SBA lender in the country, and they just have they've done an incredible job presenting data and regionally specific, et cetera. And you can see, we're not even close to how bad it was in 2008, considering that we had a historic rapid increase in the prime rate, and these are all variable rate loans. So this is where I'm most interested in is my forecast for 2024 is, I like to call it the silver tsunami, which is the business acquisition financing to the next generation.
The big handoff.
What?
The big handoff.
The big handoff, and we're seeing this rapidly accelerate, and the SBA has made this a lot easier. So historically, people think, what do you need to put down for a business acquisition? 10%. There was ways to do that with 5% from the borrower with a 5% seller note. Seller note is essentially the seller participates in the capital stack. The SBA recently changed in August and allowed for 0% borrower injections with a 10% seller note on standby for only 24 months. And standby means no principal and interest payments. 24 months, not that long to wait. Used to be the life of the loan, which was 25 or 10 years, depending on the type of loan. So 24 months, the seller's willing to wait on that. The buyer can come in with 0% down. Now, we're not going to do that for everybody, but we have been closing those loans for managers buying the business. Who better to take the business owner's legacy and treat the customers right, the employees right, interact with the vendors correctly, and be a member of the community and not a little, mini private equity firm kind of gobbling up all of the landscaping businesses to roll them up, which we see that. But we can do that with 0% down, which really opens up a wide swath of buyers that never existed before. We're talking a $4 million business acquisition, which historically would have required $400,000 in equity. We're talking literally $0 from the buyer now. And we closed a $4.8 million business acquisition for a heavy haul trucking company. 2 managers who've been there for 10 years, no money out of pocket, 10% seller note, 24 months, no real estate collateral. We recently closed a blinds, they sell curtains and blinds, $3.3 million, 5% gifted funds, seller note for 5%, payments day one on interest only. This just really changes the game for succession planning. Partner buy-ins is a new thing that's SBA eligible as well. So say somebody doesn't have the experience, maybe they're not a manager, you can sell 90% of your business and retain 10%. Maybe you could sell 99% and retain 1%. As long as you're retaining under 20%, the seller does not have to guarantee the loan. Sellers don't want to guarantee loans. I'll throw that out there. We would like them to guarantee the loan, but they don't want to do that. So if you structure it with, 81% to the buyer, 19% to the seller, you can bring in the next generation. Maybe it's an employee, maybe it's an outsider, but that mitigates to us as the lender the risk of the change of ownership. And we believe that SBA lending will escalate because of the expansion of the SBA loan programs, enabling lenders to get more aggressive. And as banks pull back, this is what SBA is for. Banks are going to do more SBA loans. Not just me. Banks in this room are going to do more SBA lending. Everybody will. It is a credit enhancement for times where liquidity is an issue. There is balance sheet lenders that hold us on their balance sheet. The way that the regulators treat it, since it's 75% guaranteed, they can lend more money. They only have to account for the 25% portion. Us non-bank lenders, we take that 75% and we sell it on the secondary market, similar to a home loan, no different. Now, one of the banks that failed, funny enough, we sold that loan in Maine to them. They failed the next day. But they failed because they were buying the low fixed rate mortgage bonds. If they bought the floating rate SBA variable rate bonds, they probably would have made it. They should have bought more of our loans. And then it's tough to predict the prime rate because a lot of this is influenced by black swan events, my personal opinion. You see what happened in COVID, that's what dropped the rates then. It was a black swan event. You look at what happened in 2008, that's what dropped the rates, was a black swan event. We don't want that. No one can predict that. But if rates start coming down dramatically, in my opinion, it's not going to be for anything anyone here is happy about. Now, it may come down incrementally, quarter point, 50 basis points in October, et cetera. But like everybody else up here said, spot on. The forecast is really not for a dramatic decrease right now. And if a dramatic decrease starts happening, we're going to probably have other issues. So it would be something I'd be careful wishing for personally. Although I am heavily incentivized if the rates go down. So it's tough for me to say that.
David, we have 1 minute left for questions.
Oh, that's it. I'm done.
Oh, thanks, everybody. I know. I'm sorry, we don't have a ton of time. Does anybody have any questions? Holler out. No? Oh, good. We answered everything. This is fantastic. Okay. Well, I just want to thank Kim, Matt, David for joining me. Thank you all for coming. Can we have a big round of applause?